Have you heard about China's ghost cities? Massive residential buildings, eerily vacant, or projects left incomplete. They've become a chilling symbol of a looming crisis in China's real estate sector. Let me break it down for you. Home buyers in China are feeling the jitters. Picture this. You make a down payment on a dream apartment, and then there's this looming doubt if the developer will even deliver. It sparked a confidence crisis. Trust waned, demand plummeted, and consequently, the property prices took a nosedive.
One of the issues for the property sector has been its rapid expansion, and in China's financial world, there haven't been as many regulatory constraints as you might have seen in other parts of the world that are more developed.
But the ripples go further. February 2021 saw a staggering surge in commercial real estate sales. Fast forward to today, and we're seeing a sharp decline. From Evergrande's major financial debacle to the turbulence in Country Garden, the tremors are felt across China's economy. The decline is evident in the Hang Seng Mainland Properties Index. And while China grapples with its post-COVID recovery, Wall Street's forecast doesn't look promising. Barclays, for instance, has slashed China's 2023 GDP growth forecast drastically. Now, official figures state real estate contributes just 6–7% to China's GDP, but some experts believe the real number, including supply chains, might be closer to 30%. So, what's really up with China's housing market, and more importantly, what could it mean for the US and the global economy? Stick with us to find out.
Part of the problem this summer in late July and early August was that the pace of the sales decline was accelerating while you had Country Garden run into these default worries.
To fully grasp the depth of this issue, we've got to rewind a bit. The year is 2014. China's once blazing housing market is cooling down, fewer sales, dropping prices, and a developmental slowdown. Now, you might be wondering, how does 2014 compare to today? Well, it was different. In 2014, the challenges were not as intense. Developers faced slowdown, sure, but not like today's wave of defaults. And the household debt? It wasn't as glaring as it is now. Fast forward to the present, and there's a shift in strategy. To finance their grand visions, developers began tapping into offshore international debt markets and seeking help from local governments, all while banking on a prosperous future. But, as we'll see, things didn't go as planned.
They really saw huge growth in the last 2 decades, and part of that was because they could buy the land from local governments and then sell those properties that they built on the land to people in China, and there was a lot of financing involved with that.
Let's dive deeper. Imagine this, a field of seemingly unstoppable giants, the big real estate companies in China, growing at a breakneck pace. But suddenly, auditors part ways with them, sending shockwaves of doubt throughout the industry. Why? The Chinese government wanted to puncture the inflating property bubble. The bubble's growth was accelerated by these developers' unchecked financing. The government's remedy? Drastically reduce financing to developers and regulate household borrowing to stabilize property prices. This tactic, though strategic, turned out to be a double-edged sword. Take Evergrande, for instance, a colossal name in property development. They defaulted on offshore debt payments in late 2021, missing even their grace period. And they weren't alone. Country Garden missed a $15 million payment and signaled difficulties in managing an astounding $11 billion in offshore bonds. You see, the government's strategy was to control developers' funding. Developers, traditionally, would borrow funds, erect apartments, then sell them. But with these new financial restraints, many found themselves cash-strapped and unable to finish projects. In fact, in 2022, 26 property developers faced what S&P Global Ratings call distress events, which includes failures to meet domestic or offshore obligations. Fortunately, The storm calmed a bit in 2023 as companies renegotiated their terms, pushing their debt deadlines to late 2024. But what's the ripple effect of China's shrinking real estate sector? It cascades globally. Less steel, cement, and glass demands weaken China's heavy industrial zones, reminiscent of the U.S. Rust Belt. Stagnant factories and waning employment become the norm. And as China sneezes, the world catches a cold. The IMF sliced its 2024 global growth forecast, largely blaming China's real estate turmoil. Add rising inflation and interest rates to the mix, and you've got a concoction of global economic concerns. China's property developers, once a beacon of lucrative investments, have faltered under the weight of their own rapid growth and immense debt. Warnings about China's debt-reliant economy echoed for years, until the government decided to implement the 3 red lines rule, imposing caps on developers' debt metrics. Word on the street was, post this rule's implementation, there was palpable fear. Real estate developers, once the darlings of the finance world, were now seen as pariahs, almost entirely cut off from financing. Let's take a step back and look at the bigger picture. The Chinese government, in its bid to control the property bubble, implemented the 3 red lines policy. The impact? China's default rate soared to 4.4% in 2021 and then, alarmingly, doubled to 8.2% the following year as per S&P Global Ratings. Now, when the gravity of the situation became evident, what did the officials do? Just a few months back, the central bank and other key officials pivoted. They slashed the minimum down payment for first-time home buyers to 20%, and for those looking at their second property, it was set at 30%. Alongside, they nudged lenders to offer lower rates on existing mortgages. The objective? Re-energize property sales. The question is, how effective was this? To be frank, the results are mixed. There's been a determined push to invigorate housing demand, but we're yet to witness a robust V-shaped recovery. Instead, it's been more of an uphill battle to restore consumer trust and stabilize housing demand. Let's highlight a crucial distinction here. Private sector developers often tapped into the international market, issuing bonds to global investors for their expansions. On the other hand, state-backed developers primarily sought funds domestically. The implications of this strategy were quite telling in 2021 and 2022. Privately owned developers faced a staggering default of $35.4 billion, while their state-backed peers saw a relatively minor fall to $190 million. But let's not paint an overly rosy picture for state-owned developers. They too grappled with the repercussions of waning demand, although their struggles weren't as acute as their private counterparts. Here's a startling statistic for you. Over the past decade, offshore defaults in China's property sector have surged from a manageable $4 billion in 2015 to a staggering $54 billion in 2022. The default frequency? It tripled, echoing the concerns raised by S&P Global Ratings.
I think Chinese government would try to let those private developers to negotiate with creditors and to get those things done to try to stabilize it, instead of trying to leverage on central government to bail them out.
Diving into the nuances of China's real estate landscape reveals a fascinating bifurcation. How property developers fare significantly depends on where they're operating. Think of it this way. Just as New York's property market, despite its fluctuations, invariably bounces back due to its appeal. Jobs, education, healthcare, the larger cities in China have a similar draw. People flock to these metropoles for opportunities and amenities. This dynamic means that developers like Evergrande, which had a greater focus on lower-tier cities, face different challenges than those who invested predominantly in top-tier urban centers. But here's where it gets even more intricate. Local governments in China have been given the autonomy to tailor their property policies. China's central authorities granted city-level governments the discretion to set criteria for first-time homebuyers. And the results? Quite varied. While cities like Shanghai continue to thrive, many other Tier 1 and Tier 2 cities are witnessing a slowdown. This indicates that the impact and success of these policies can vary dramatically depending on the region. China's property market is, without doubt, facing tumultuous times, a situation that many experts never foresaw. The uncertainties surrounding stabilization are a concern not only for the local economy, but for global economic perspectives as well. Many now understand that the prospects for an immediate stabilization might be overly optimistic, particularly as we head into 2024. Moreover, the challenges are not merely cyclical, but structural. The long-standing construction boom in China, once seen as a symbol of its rapid development, now appears oversized, given the declining demand resulting from factors such as slower urbanization rates and an aging population. In retrospect, the past 2 decades have brought significant advancements to China's housing standards, which means that there's less inherent need for new housing developments moving forward. The lack of transparency in data and information. If you found value in this content, please help us grow. Subscribe to the channel, hit the like button, share with your friends, and leave your comments below. Your engagement makes all the difference and helps us continue producing quality content for you. Join our community now.